Welcome, Anders. Nice to have you back in the studio today. Looking at what's going on in the world, we've seen some relatively strong performance from equity markets recently, despite all of the turbulence that we've seen in the Middle East. How is that? How can it be that way?
Well, I think you have to take the starting point that if you compare the situation to the 70s, OPEC and the Gulf doesn't play the same role as it did in the oil market. Roughly a half of the oil production in the 70s and now some 20%. And you know, if the oil price today would be equivalent to what we saw in the 70s, oil would probably have to go above $300, and oil doesn't play the same role in the economy either. Global GDP is not that oil dependent as it was 20 or 30 years ago. So I think the main reason why the oil price really haven't hit growth is the fact that the oil market in itself are so convinced that oil eventually in Q4 will come down again. If you look at the future contracts for December or March, they are actually closer to $80. But even more important, normally the impact from oil prices on the global economy comes from financial stress. And the level of financial stress right now is extremely low. We've just seen the Q1 reports from the banking sector, and in terms of liquidity coverage ratio, non-performing loans, tier 1 capital, or for that matter, a return on equity. The US banks are probably in their best shape for the last 10 years. And this is also true for European banks and for Nordic banks. So the fact that the banking system is so healthy means that we are not seeing credit being strangled. We haven't either seen a big increase on 10-year or 2-year government bonds. There's been a bit of an uptick, but they are still trading in the kind of ranges that they've been for the last 2 years or so. So we haven't seen an interest rate shock. One should also add that given the cost of living crisis, most advanced economies have seen house prices go sideways or even down a bit over the last 2-3 years. And this implies that we don't have a house price bubble at the moment. And normally the big contraction to demand actually comes from house prices coming down and the households rebalancing their balance sheet. And on top of that, we obviously have an extraordinary support from the stock market in terms of the AI. We saw last week when Google, Amazon, Meta and Microsoft reported that revenues were actually increasing at an even faster pace. We used to have these companies growing their revenues with roughly 15% or so, and now they are closer to 20% or above. And if you look at the recent reports, if you calculate the return on equity from the investments that they are doing in AI, if you combine the high margins on software and chips with the slightly lower margins on energy and data centers, you still have an EBITDA impact of some 25%. And given that you have the weighted average cost of capital closer to 9 or 10, these are exceptionally high returns on investments. And we have seen that AI have really scaled out in terms of the capex. This year it's more likely to be roughly $1 trillion and accelerating up to $1.5 trillion next year. So part of the stock market is doing exceptionally well. But what is interesting with the US reporting season is that we see the net sales growth actually broadening out. We have more than 10 sectors in the stock market getting closer above 10% year-on-year growth. And at the same time, margins have expanded. Right now, we are close to 15% margins in the US stock market. And US is 65% of global market cap. So when the US stock market is doing this well, we actually have a strong force to support global growth. So at the same time, if you look at the macroeconomic situation, we have to take the starting point that China is doing very well. Even in a scenario where oil would remain at $100 at year end, we're likely to see China growing 4% and rest of Asia closer to 5%. And when also US is doing well with growth around 2%, well, that's actually 70% of global GDP that are growing at potential level or even above potential level. So yeah, demand is growing, capex is growing, and if you take the universe of Asia and the US, productivity growth is also fairly solid. This week we are getting US productivity numbers, and they are likely to be very close to 3%. So in that environment, we are in pretty good shape.
So the US has more to give. And if we turn and think about emerging markets, which you've touched on a little bit, and how that follows on the Q1 reports, but also year to date, we've also seen very strong performance there, which is something that you've been discussing a lot with our investment team. So how do you see the very strong results that we've seen so far year to date in emerging markets?
Well, first and foremost, we have to talk about AI. Now people are using more and more AI, and everybody needs to store the data. This means that memory chips are booming, and clearly Korea and Taiwan and Japan are in the lead in that field. So we've seen a really strong performance from the Korean stock market. But it's not only AI. We can also see that in spite of tariffs, China is doing very well on batteries and EVs. And in general, we can see a very strong export performance from China. And basically those are driven by technology like AI, renewable energy, and batteries and electric vehicles. But we're also seeing them more broadly because China has such a strong competitive positions in heavy industries. So their steel export is growing rapidly. Chemical industry is doing very well. They are expanding on pharma. And when China is doing this well, and the rest of Asia is kind of pretty strong, you have a benign picture. I mean, FT had an article this week when they talked about the increasing oil pain on Asia, but in the article you could read that the Asian Development Bank had reduced their forecast for 2026 from 5.1 to 4.9 or something like that. So clearly underlying fundamental growth in Asia is very strong. And we know that the stock markets there also get a lot of retail support because saving rates are higher in Asia, and a lot of the households are now entering the stock market as retail investors. So in general, you have support from technology, you have support from superior competitiveness, and also from a domestic high saving rates that flows to the capital markets. So yeah, this is an exceptionally strong period for emerging markets.
If we turn to Europe then, how do we see Europe unfolding here?
So if you look at the Eurozone or UK, these economies are growing very slowly. Potential growth is around 0.5 percentage point. Labor force is shrinking. Total factor productivity is low, and we haven't seen any investment boom really in Europe. So underlying growth in Europe is much weaker. And there is a long-term challenge for heavy industry. Automotive, steel, chemical, all of these sectors are now under increased competition from China. So yeah, we really need to see a broad-based reset of European competitiveness. The positive thing in Europe is that clearly Central Eastern Europe is doing much better. Poland is going from strength to strength, growth above 3%. Any potential peace deal would further boost demand. But we also seen improvements in Hungary after the election. So Central Eastern Europe is characterized with really hard-working people that educate their children with strong productivity growth from adopting to new technologies and actually benefiting a bit from the cost problems in your area. So overall, I would say that the best space in Europe is also the emerging market part.
And if we zoom in on to Sweden then, what do you say for Sweden?
Well, the Nordics are stronger. Sweden are stronger. Even in a severe scenario, you're likely to see Swedish growth slightly below 2%. And in the main scenario, it's pretty likely that Sweden will be 2.5% to 3% growth. The tech sector here is much stronger. Very vibrant VC market. Cost control is better in terms of wage increases and also a bit of bump on productivity. So yeah, the Swedish stock market has pretty good support. However, one should note that our stock market is very heavy on industry. It is heavy on materials. It's a big banking sector and also a fairly large real estate sector. So there is a bit of composition here, but the underlying fundamentals are really strong with very decent profitability, strong balance sheets, and a tilt towards technological leadership and high R&D spending. So in Europe, I would probably prefer the Nordics to the euro area.
So if we're summing up, we have some positive optimism going forward here for where we're headed?
Well, obviously there is geopolitical noise, but as long as we see the stock market performing and as long as interest rates are low and the banking sector remains solid, I do think that the financial stress part of this oil crisis is going to be much, much more limited. And that puts us in a good trajectory going forward.
Excellent. Thank you very much for the update today.
Thank you very much.